Just to give you some background on me, so my name's Pete. I teach every single paper on that list, so I know all the intricacies of different qualifications and where present valuing comes in, and exactly in what way it's tested at various points. But what I find usually is that often the difficulties people have with present valuing is based on often a failure to understand some of the crucial kind of fundamental points of it. And if we can iron those out, then actually everything else becomes much more logical. All right, so I'm just going to get rid of these polls for a sec. Let's hide this. And let's hide this. And aha! Unfortunately, not a picture of my desk. My desk isn't quite as clean as that, but you get an idea of what we're trying to go after. So my background, I've been a teacher of first institution. This is my 7th year. Background in audit and also working in investment banking. Did a lot of present valuing in investment banking. A lot of my time was taken up with that. So I've seen this in the real world and also in the qualification space as well. Things we're going to be doing today. So we've talked about the kind of stuff you guys are studying towards. Majority of people doing ACCA, some people doing CIMA as well. And typically at the kind of second stage. So you're encountering PVs for the second time at kind of financial management or P2 level. I'm going to briefly dip back into what exactly present valuing is. Then we're going to talk about exactly how it slots into investment appraisal and why we care about it. I find that a lot of the students that I talk to know how to calculate a net present value, but if I asked them why they were calculating it, they wouldn't necessarily be able to tell me. I want you to be able to walk up to somebody in the pub, of course, with appropriate social distancing, and when things got a little bit nicer from a pandemic point of view, and explain to somebody in plain English why you're doing what you're doing. I think that's the real definition of understanding something, if you can explain it in simple terms. Then that problem area that a lot of you guys have been talking about, dealing with annuities and perpetuities, and particularly delayed start annuities and perpetuities, so that second level of a challenge that we have, like I just mentioned. And then finally, we'll be giving you guys a couple of example questions to have a look at. And again, this isn't necessarily going to mirror an exact question you might get in the exam, but it's going to challenge you to be able to use some of the stuff that we've studied today and then apply it in a couple of different contexts, an easy one and a more difficult one. Okay, right. In that case, let's get kicked off. Let me just pop over to our teaching pane. Oh, and by the way, if I just pop back to outline, the downloads I've put up, if any of you need dates for class in the second half of the year for ACCA or CIMA, they're all up there for you guys to download. I'll give you a link through to the website at the end as well. So I hope you're fans of PowerPoint and animation, because boy, have I got some animations for you. First thing, why we care about present value in the first place. So we've done some questions, we've dealt with that. Okay, so apologies if this is covering the basics, but I'm going to do it quite quickly, just so everybody gets to grips with why we're doing present valuing in the first place. All right, so hopefully we can all understand that if we had 100 quid spare, we could stick it in an interest-bearing account, and if we left it there year after year after year, it would accumulate interest. Now, the fundamental point that we're assuming on pretty much all of our studies in CIMA and ACCA, like it sounds like most of you guys are doing, is that any payments are going to happen at the end of a particular period, so in 1 year intervals, and that we are quoted annually compounding interest rates. So if I tell you that we've got a bank account that pays 10% interest, I mean, if you put £1 in it today, then in 1 year's time, it will then pay you 10 pence worth of interest on that £1. Now, the idea is about compounding is that the more periods you have it in for, not only the initial amount you deposited, but also any interest that you've been credited also earns interest. So we put £100 in straight away. In 1 year's time, that grows by 10%, so multiplied by 1 plus R or 1.1, and gets us to £110 in 1 year's time. But to go from the end of year 1 to the end of year 2, well, we're growing by another 10%, but now it's the £110 that's growing. So we're earning interest not just on the £100 we started with, but also on the £10 of interest we've got so far. And that takes us up to 121, and so on and so forth. To year 3, we're earning interest on the 121. to get us to 133.1. Year 4, we're getting up to 146.41. Year 5, we're getting up to 161.05. Okay, so this is compound interest in action. Every single year, at the end of it, we're getting an amount of interest credited to our accounts that is based on the amount we had right at the start of that period. So we're going to see later on that one of the most fundamental points about present valuing is identifying when cash flows are happening. I think a lot of you guys on the call, particularly those of you doing objective test stuff like CIMA P2 or some of the earlier questions in ACCA FM, if you can just jot down when the cash flows are happening, it saves you from making silly errors, effectively. So, next point to note is the terminology we're going to be using. So we're not going to be thinking about compounding 1 year at a time. We want to skip immediately from T0 to T5. And by the way, this naming convention we're using here, you should also be using in your exams. That being T1 is in 1 year's time, T0 is immediately as I snap my fingers, T2 in 2 years' time, and so on. So always thinking about the end of that period. If I told you a cash flow happens at the beginning of the first year, that's T0. If I told you it happened at the end of the first year, that's T1. The beginning of the second year would also be T1. I don't really differentiate between, say, the 31st of December 1 year and the 1st of January the next. There isn't enough time for you guys to earn any interest in between. Okay, so that's the important result as far as we're concerned. We then get this generic result that if I put a certain amount on deposits today and I want to know how big that's going to grow to in n years' time, then all I need to do is multiply it by 1 plus r to the n, where r is my interest rate, so the 10%, and n is the number of years into the future we're going, the number of compounding periods. That's the idea. Now, the reason we stress that is because this is what underpins present valuing. The P that we talked about here, in this case, the 100 quid, that's our present value. We can then work backwards. So if we're told that we're going to have £161 and 5 pence on account in 5 years' time, the question is, how much do we need to have on account today? Well, we can then reverse what we're doing and divide that future value by 1 plus r to the n. Okay, so 1 plus our interest rate to the power of the number of years into the future we're looking at in terms of the cash flow that we're looking at. That's the idea. So again, we can apply it to the above and say, well, we've got the 161.05. We can divide that by 1.1 to the 5 to get back to the 100 quid that we must have started with. So most of you will have encountered this when you did, say, ACCA MA, CIMA BA2, so earlier on in your studies, but it's just refreshing your memories on that. Hopefully none of that's too shocking for anybody so far. Right, so I think what I really want to dig into is, having started out with this viewpoint, really digging into why we care about present value and what it actually represents. Okay, so you're going to see this term referred to quite a lot, the idea of the discount factor. So it's a number we're going to multiply a future cash flow by to find that present value. And you need to both be able to calculate it directly and also to be able to use tables that you get in your exams in order to find it. Okay, so for instance, an easy question should hopefully be, if I tell you that you're going to have 20 grand in 4 years' time, and there's a 5% annual compounding interest rate, then what would the present value of that be? Anybody fancy quickly chucking that into the chat box before I reveal it? This is where I find that nobody's got any calculators to hand. Probably people furiously scurrying around trying to get their phones, Excel spreadsheets, whatever it might be. Let's see if anybody's feeling particularly brave. No problem if nobody's feeling brave. While you're thinking about that, I'm just going to show you the other source that you can get these discount factors from. So you can manually calculate it by dividing 1 by 1 plus r to the n. It's also the case, if I just bring up my tables, that you should get something in the exam that looks a little bit like this. This is the ACCA version that you get. You get a very, very similar table for CIMA, for instance, but this shows you the periods into the future you're going and the interest rate you've got and gives you that discount factor. So each of those is a 1 over 1 plus r to the n, but just a standardized version rather than you having to go ahead and calculate it. All of those rounded to 3dp. Okay. So I don't think anybody's feeling particularly brave at the moment. Oh, I have. Raki, thank you very much for saving my bacon there. So yes, we have 16,460. So Raki, I'm guessing you used the number from the discount table or the present value table, the 0.823. Excellent, good to know. So usually that's what students find it easier to do because it saves bashing numbers into your calculator. But obviously it's the case that sometimes if I give you an interest rate that isn't a whole number, or maybe a time period that's further than 20 years into the future, your tables don't cover it. So you need to be able to do both of those. Something else that I thought was worth mentioning, some people get a little bit tied up in knots when they try to divide by 1.05 to the 4. So maybe an easier way of entering it in is 1.05 to the minus 4. Okay, raising a number to a minus power to the equivalent of doing 1 divided by that number. Okay, right. So that's great. And hopefully everybody on this call can go ahead and crack away and get the 16,454 or the 16,460, the difference being a little bit of rounding. But I mentioned at the beginning, I want you guys to be able to walk into a pub of your choice and explain to somebody why you care about a present value. So here's my pitch. I am personally going to open up my Swiss bank accounts and get out £20,000, and I'm going to promise I'm going to pay it to you in 4 years' time. You have got no need to worry about me. I'm in perfect health, as you can see. I'm not a flight risk. I'm not going to emigrate to a country with no extradition treaty with the UK. You are certain that I would pay you that £20,000 in 4 years' time. But you've got to wait 4 years for it. So I give you a tempting offer. I say, actually, I would be happy to pay you a slightly lower amount immediately. Now, what you need to understand is how valuable money is to you. You need a cost of capital. Marta, yes, £20,000, albeit I'm not sure how much the pound is going to depreciate but against other currencies over the next 4 years. So I'm not going to inflation link that. That's £20,000. That's it. That's what you're getting in 4 years' time. Now, you need to understand what your cost of capital is. So how valuable money is to you. What's the price of using money? So I'm going to give you two different situations you might think about. Either you guys have got you're flush with cash and you've got a savings account, or you're in debts and you've borrowed from people. So two different situations. Situation number one, let's imagine that you've got a 5% savings account. So you're getting an annual compounding interest rate of 5%. What that means is if you had some money today, you could chuck it in that account and earn 5%. More likely in the current environment, let's say you've got an overdraft or some debts and you're having to pay 5% compound interest on that. So clearly there is a value to you in having cash immediately rather than having to wait 4 years to get your hands on that cash. Okay. For example, if I gave you some cash today, if you were in that first situation, then you could take that cash and chuck it into a savings account and you would earn 4 years worth of 5% interest on it. So therefore there would be value to having it today rather than in the future. Maybe more likely from the point of view of a business or a lot of individuals at the moment, if you had that money today, you could use it to repay some of your debt and save you having to pay interest at 5% for the next 4 years. So hopefully everybody can appreciate that if you had money today, it would be more valuable to you than the same amount of money in 4 years' time. But I'm not an idiot. I'm not going to offer you £20,000 today. I'm offering you a lower amount. So the question is, how much less would you be prepared to accept today to have an equivalent value in 4 years' time of £20,000? And that's what your present value is. It's how much less you'd be prepared to accept today instead of having that cash flow in 4 years' time, what it's really worth to you in present terms. And that comes back to what we calculated up above, what Raki calculated up above. So if you were certain that I wasn't going to flee the country and I was definitely going to pay you in 4 years' time, If you had a guaranteed 5% savings account, or you knew that you were borrowing money for the next 4 years and you were having to pay 5% on it, and that 5% wasn't going to change, then you would be happy to accept 16,454 today, and that would be as good as you getting £20,000 in 4 years' time. There would be absolutely no difference between those two things. That is assuming that you would immediately bank that money or use it to pay off the debt, rather than going out and splashing it on whatever £16,000 can get you. I would say a mid-sized family hatchback with no options spec. Okay. So guys, how does that sound? Are you guys getting why we care about the present value? You can either chuck it in the chat box. If you go, you can click your little reactions button at the top. There's a drop down next to it where you can give me a green tick for agree or a red cross for disagree, laughter, or even some applause maybe. Okay, I'm getting some green ticks. That's good to see, guys. All right, so now we're going to build on this. So that's what a present value represents. What about net present value? Because this is the thing that you're going to be assessed on in the exam ultimately, particularly in FM and P2. So, appraising investments. I don't think it's a shock to any of you to see something like this. Okay. Now, I'm working in the finance department at FI as well as teaching here. We're constantly trying to appraise potential investments that we might make. Okay, so things like spending money on additional tutors, additional teaching space, spending money on software to improve our teaching, spending money on software to allow us to teach more people or more room to teach people. Okay, all of this has or tends to have an upfront cost. Okay, if you're looking at a typical business, they want to expand their premises. They want to buy new machinery. If you're a brewery, then you're going to get a refrigerated delivery van. It's going to allow you to make more deliveries or employ extra people. Okay? So the idea is you're going to have this initial cash outflow, and then you're going to have subsequent cash inflows. We're going to make it a little bit easier than real life, though, because we're always going to say that these cash flows happen at 1 year intervals. So you're going to have to pay a bunch of money now to buy something like a machine, and then you're going to get money out of that. So there's going to be increased sales, you're going to make increased profits in the future. All of these are also relevant cash flows. These are cash flows that are only happening because you're making this investment decision. So these are this new revenue you're going to get, it's new costs that are going to be incurred, that kind of stuff. Okay, and this is all cash. I'm not talking about revenue recognition. These are cash in and cash out. Right. So how do we appraise it? Well, what we can't do is simply just add all of these numbers together. And I've deliberately made it so it's £40,000 in 3 years' time and £40,000 in 4 years' time. So they're directly comparable. I think we all understand that the £40,000 that we're going to receive at the end of year 3 is more valuable to us than the £40,000 at the end of year 4. Because the £40,000 at the end of year 3, I would have the opportunity to bank that for 1 year, earn some interest on it before we got to year 4. Okay, so it's better for me to have that. And I can see that I've got another class participant. You can see, sorry, going the wrong way. One of my cats has wandered onto the bed behind me. Apologies for that. Hopefully she doesn't make any crazy noises during the course. So I need some way of comparing these things with each other. And often the easiest thing to do is to get everything in present value terms so that the cash flows are directly comparable. And I can compare the present value of all of this future stuff to the immediate cash cost of me entering into this project, this opportunity that I've got. So that's why we work out the net present value. We're going to work out the PV of the cash flows in year 1, year 2, year 3, and year 4. And then we can compare them to the initial cost to get my NPV. And I'm sure you guys are all well rehearsed in telling me that if the NPV is positive, then it's worth going ahead and doing the project. That's the idea. So in terms of calculating the net present value, we need a few things. The first thing we need is a cost of capital. Now, those of you that are doing ACCA FM, you will be working out the weighted average cost of capital as part of your studies in other areas in the syllabus. Those of you doing P2, you'll be calculating the weighted average cost of capital and thinking about the cost of equity and the cost of debt in the F2 exam. For the time being, let's not worry about where this is coming from and how the cost of capital is being calculated. We'll be provided with it. But the important thing for us to think about is it's the cost of us using money. Okay, so what could this money otherwise be doing? And usually we're going to be basing this on, for instance, the amounts that we're paying to our lenders, the amount of return that our shareholders require. So if I'm going to spend £1 and I've got, say, lenders that expect 3% interest off me, I've got shareholders that expect a 10% return every single year, I need to be making some return off of that pound just to tread water and keep up with zero. Okay. Now, to calculate this NPV, two ways of doing it, like we saw in the previous slide. Either you could go exact and take each of those individual cash flows and divide them by 1 plus r to the n. If I tell you that r, our cost of capital, is 4%. Or, probably the way that a lot of you guys do it in the exam, you can go into your PV tables and find the appropriate discount factors to use. Now, if I just again pop to our present value tables here, then we're looking at 4%. And we've got 0.962, 925, 889, 855. All of that just being 1 over 1 plus r to the n. So 1 over 1.04 to the 1 to the 2 to the 3 and to the 4. We'll talk about the cumulative PV table later on. Okay. Now, I have a challenge. Unfortunately, there are no prizes for this challenge, so I'm not going to be sending any trophies to you through the post. But can anybody tell me, my challenge to you is, in 1 or 2 sentences, can you tell me what the £16,750 represents? If you met somebody, you were on a date with somebody and trying to impress them, you met up with your friends at a bar, you said you'd worked out a net present value, and they said, what's that? How would you describe that to them in a sentence? Can anybody give me anything logical? Because I think if you understand this, then you can do the chatty stuff. So for CIMA, if you get to management case study, in ACCA FM, when you get to those written questions, you might be expected to explain what this represents and to use it to then explain other stuff too. I've got a few people typing away, bashing away on the keyboard. I love it when I see that multiple attendees are typing. It means that either something good's happened or there's a terrible technical problem. Hopefully it's the former. How much the shareholders' wealth will be increased if the project is undertaken. Okay, and how the value of money changes over time. Suzanne and Emma, that's great, but I am not particularly intelligent. I need you to break it down even more for me. Something that you could approach somebody who doesn't really understand what shareholder wealth is or what time value of money is and get it across to them in a sentence. I know it's a big ask, and I'm sorry that I'm forcing you guys to do it, but I think if you can grasp this, then you're set. I see Marta's having a stab. How much money the project is worth in today's money. I think that is a very nice way of putting it. I've done something similar here. Here's my description of it. See if this is doing anything. Why isn't this clicking? Apologies. Let's try this again. I think my PowerPoint was getting a bit confused. Here we go. So I'm saying that the 719, or the 16750 is effectively the value of the excess cash that you're going to be left with at the end of this project, but in present terms. Okay, so I'm trying to put this in simple terms for you guys. So let's say the cost of capital is something really easy. Let's say it's just our cost of borrowing. Okay, so we borrow money at 4% to invest in the project. Any cash that we receive, we are going to pay that to pay back the debts. And once we've paid back the debts, we're going to bank anything else and earn 4% on it. Okay, so you pay back the money you borrowed to invest in the project, and any other money you get after that is going to earn you 4% a year. If you worked out what your bank balance would be at the end of it and worked out the PV of that, That is what the net present value is. So it's the present value of the money you're going to earn that you're going to be left with at the end of the project. Okay, or to put it in more simple terms, the amount of money you're left with at the end of the project, it's the present equivalent of that. It's how much it's worth in today's money, effectively. But we're not talking about necessarily inflation here. We're talking about the time value of money. Inflation might be part of that, but it's also simply the case there's value to having money and a cost to using money. Okay, so I want you guys to think the net present value represents the value of the excess that you're left with at the end of the project. So if you've got a positive NPV, it means that after paying back all of your investors, the people who've given you the money to invest, there's still a little bit left for you. And that's what the net present value represents. Okay. So that's nice. And obviously in exam worlds, particularly in ACCA FM, you're then going to have to think about all the cash flows that go into this pot, because ultimately the bit that we're doing here right at the end, that is after having worked out your revenues, your costs, tax, dealing with inflation, dealing with capital allowances to work out the net cash flow at the end of each year. Okay. We can make this a little bit more complicated by bringing into the mix annuities and perpetuities. Okay. So these should actually make our lives easier, but I think that actually in a lot of cases they just confuse people. The idea behind an annuity is it is a constant amount of cash that you receive starting in 1 year's time, and that bit is very, very, very important. The first cash flow happens 1 year from now, and it has an end point. That's why it's called an annuity. So an annual constant cash flow starting in 1 year's time always, and ending a few years into the future. So a 4-year £1,000 annuity will look something like what I've just chucked up on the screen there. Right, that's fine. The question is, how do you present value that? Now you could go ahead and find out the present value of each of those £1,000 individually, or you could use a shortcut. So these two things are equivalent. This is probably a formula that you guys get in your exam, A over R, 1 minus 1 over 1 plus R to the N. I'll show you how you're given that in the ACCA formula sheet. If I just pop back to our discount tables that we've got, you've got what's called a cumulative present value table or an annuity table. And they also might give you the formula in this way. So they've taken the A, which would be the £1,000, out of it. They're just talking about a £1 annuity here. And 1 minus 1 plus R to the minus N over R is the same as 1 over R, 1 minus 1 plus R to the, sorry, 1 over 1 plus R to the N. So whichever way they give it to you, it's the same thing. Just pop back to my, whoops, there we go. And all that is, and if anybody was really interested and maybe on another call, I could prove to you that all that is a simplification of this. So it's a simplification of individually present valuing each of those cash flows. Using a little bit of algebra, you can compress it down into this formula over here. So all it is a shortcut. There isn't really anything special about annuities. They're just a series of cash flows. There's a shortcut to finding the present value of them. That's the important thing about it. Now, what a lot of you guys would rather do probably is go to your annuity tables and just find an annuity factor. So I'll give you 2 bullet points here. So if I told you that we had a 5% cost of capital or a 5% interest rate, and we had a 4-year £1,000 annuity, we could chuck it into the formula. And if any of you guys have got scientific calculators in front of you at the moment, I would love for you guys to prove to me that you could calculate the 3546. So 1,000 divided by 5% times 1 minus 1 over 1.05 to the 4. Or alternatively, as many of you will do in a more simple situation like this, you can pop over to your formula sheets and you can find your annuity table, and you can go down and you can find 4% and was it 4 years as well? No, sorry, it was 5%. I'm being silly. 5% and 4 years, 3.546. Now, all that 3.546 represents is the present value of me paying you £1 every single year, starting in 1 year's time for the next 4 years. Okay, that's it. If you had a 5% cost of capital. So, hopefully nothing shocking for you. I think the two things to come out of this that are important are thing number one, that you can apply the formula, because it's very easy for the examiner to ask you about, say, the present value of 30 years worth of cash flows, or not giving you a whole number as the cost of capital. And the fact that you appreciate that you can only use this on its own if the cash flow starts in 1 year's time, because I'm going to show you later on what happens when it's delayed, a delayed start annuity. Okay. Perpetuities are just a lead on from this. The only difference is that perpetuities don't end. Perpetuities are quite important to us because when you come to thinking about things like, say, preference shares and shareholdings, we think of them as perpetuities of cash flows going off for infinity. So here's my same £1,000 every single year, but these 3 dots over here represent the fact that I'm going to pay you £1,000 every single year, starting in 1 year's time and going on forever. Now, the reason that we can present value this is because the present value of a cash flow that you're receiving in 20, 30, 40 years' time is going to be very, very, very small. Okay, so hence, actually, the value is really coming from the more immediate years we've got. The way to think about this, and you might not get this formula in the exam, it depends on what syllabus you're looking at, is if I show you my cursor, if you look at the annuity formula up above, if you imagine that n was a very large number, 1 over 1 plus r to the n would be a very small number. And then that formula would just become a over r times 1 minus 0. And therefore, a over r. So our formula to present value of perpetuity is super, super easy. Whoops. Let me go back. It's my previous slide. Here we go. So the formula is really easy to present value of perpetuity. It's just dividing the annual cash flow by whatever your cost of capital is. And so it's just a simplification of the annuity formula. We use this to present value preference shares. We use it to present value irredeemable debts when you get onto either doing F2 or looking at it in FM. And the important thing is that, again, it's the same principle as the annuity formula. The first cash flow is in 1 year's time. So can I get some green ticks or some yeps in the chat box to let me know that you guys are relatively comfortable with annuities and perpetuities? Because I think the problem often is that you get taught this at a very early stage of your studies, and then there's plenty of time to forget it or get a slightly skewed view of exactly what it represents. Okay, I'm seeing some green ticks coming through. That's good to know. If anybody has any questions, don't be afraid just to chuck it in the chat box as we go. All right, now, the more tricky bit. What happens if I tell you that I'm going to pay you £1,000 a year, but actually it's not going to start in 1 year's time? It's going to be delayed. And this is where we start to get into the more FMP2 extra level of thinking about things. So we need an adapted approach if we have a delayed start. So the example over the previous page was £1,000 every single year for 4 years, starting in 1 year's time. Let's imagine that we now have a delay. Now, my first rule for dealing with anything like this is the easiest rule to remember, and that is you are always going to write down the cash flows, because it's so easy to make a stupid mistake by just reading the text of a question and then starting to slam numbers into your calculator. You're always going to write this down if you can. Having done that, I'm still going to use the same formula, because I still know that annuity formula, or using the annuity factor that we get out of our annuity table, is still going to take those 4 cash flows and crunch them down into one number, one lump sum. What I want you to think about, and if I go onto the previous page, if this will allow me to. On the previous page, what I want you to see is that all we were doing was we were taking the £1,000 that we had here and we were turning them into one lump sum at T0. So one lump sum the year before the first cash flow. We're still going to be doing that here. So what I'm going to do is I'm going to use the same formula that I had. Either I'm going to chuck the numbers into the formula with 5% and 4 years, or I'm going to go and get my annuity factor from my annuity tables of 3.546. Whichever approach you want to use is absolutely fine by me. But it's now no longer the case that this gives us the present value. And here's where hopefully my animation is going to hold up. Instead, what it gives you is it takes those 4 cash flows and it converts them into one lump equivalent sum the year before the first cash flow happens. So we can still use the formula, it just gives us something that's slightly different. So instead of giving us the present value, it gives us the T2 value because the first cash flow is in T3. Just to picture this, if the first cash flow was in T1, it would be giving you the T0 value, which is the present value. Now it's giving me the value 1 year before the first cash flow, the T2 value. So guys, is that making sense? If I just quickly clear your statuses, can I get some green ticks if that's making sense? Because there's a couple of ways to deal with this problem. This is the way that's going to serve you the best when it comes to harder things like growing annuities and growing perpetuities that you get later on. All right, so somebody tell me, we've got a 5% cost of capital. I'm telling you that the value of these cash flows is equivalent to £3,546 at T2. What's your T0 value? What's your present value? Anybody care to tell me? 5% cost of capital. Suddenly everybody's gone silent. It might be easier if you just forgot about the £1,000 at this point, because I've just converted them into one number. So now I'm just telling you, I'm paying you 3,546 in 2 years' time. What's the PV of that? Okay, all right. Maybe people feeling a little bit nervous or maybe a little bit confused. It's super straightforward. To find out the PV, all we're going to do is discount it back from T2 to T0 by dividing it by 1.05 squared. Or alternatively, if I pop to my present value table in the exam over here, by multiplying it by 0.907, okay, a 2-year 5% discount factor. So for delayed start annuities, the trick is to think about it like a 2-step problem. Step number 1, turn all of those £1,000 into one chunk. Step number 2, take that one lump sum and discount it back to present. That's all we're looking to do. Now, like I said, this is the way to tackle it that sets you up the best for harder things that you might face in the future. There is an alternative way that people might choose to do it. And by the way, 3216, that's the present value we're looking to get to. The alternative way to do it is to find the PV of a 6-year annuity. So imagining that we were getting the £1,000 in year 1 and year 2 as well, and then deducting the present value of a 2-year annuity. So I could go to my present value tables, if I find them over here. Go to my annuity table, and I could say, right, 5% for 2 years is a 1.859 annuity factor, and 5% for 6 years is 5.076. Okay. So if you do the difference of those two things, like so, then you get to the same points. I think you'll all forgive me a £1 difference between the two answers. One of them was doing exact calculations, and the other one was using numbers rounded to 3 decimal places. Now, in my 6.5 years of teaching this, I find that students tend to understand conceptually the second method better. But if they can understand the first method, it actually sets them up better for dealing with things like the valuations topics that you're going to see in ACCA FM and CIMA F3, for example. So if you can grasp that now, it's going to serve you well for the future. Can I have any questions, guys? Anything that anybody would like to pose to me at this point? We've got some questions that I'm going to set to you in a moment. And we're also going to talk about delayed start perpetuities as well. Is there anything that's troubling you about this? Anything that you're not getting? Okay, if anything does occur to anybody, just give me a shout in the chat box down below. For the time being, though, let's apply the same approach to, it will let me, delayed perpetuities. So the same kind of deal. It's still the case that our formulae are based on having the first cash flow in 1 year's time. So now, instead of having a £1,000 perpetuity that starts in 1 year, how about we say it starts in 3 years' time? So it looks like this. It's a very, very similar issue to the annuity issue that we saw on the previous page. And like my annuity issue, we've got 2 different ways of potentially attacking it. Okay. Way number 1 that I would prefer, personally, is again to use the perpetuity formula. So dividing the £1,000 by your cost of capital, which we're saying is 5%, because that's what we've been using over the previous pages. If I do that, that gives me the value of this perpetuity 1 year before it starts. So it gives me the T2 value of it as a lump sum, like so. You can tell I've been enjoying using animations on PowerPoint. So we said that the present value of £1,000 every single year starting in 1 year's time was £20,000. I'm saying to you that the year 2 value or equivalent value of £1,000 every single year starting at T3 is also 20,000. Again, all we need to do from this point to find the present value of that is just to PV that one standalone number, £20,000. And again, I can go back to my discount tables. Oops, let's try that again. There we go. And I can go straight to my 0.907, and I can multiply by that, or I can divide by 1.05 squared. Same deal. And that's all we're doing here. So if I can work out that the value of it in 2 years' time is £20,000, it's very easy for me to then work out what the present value of it would be. Again, you could have done something similar and deducted the value of a 2-year annuity from it, because effectively it's like I've got a perpetuity starting in 1 year's time, but somebody's removed the first 2 years' worth of cash flows. So again, what I could have done is I could have taken the value of a 2-year £1,000 annuity from it. Again, taking my annuity factor from my discount tables over here, 1.859, and just removing that from the value that I had already come up with based on starting out in 1 year's time. So, like I said, 2 different ways to approach this, but in each case, I think the first way sets you up well for dealing with more challenging problems later on down the line, potentially. So, with that in mind, I've got a couple of things for you guys to think about, and I'd like you to have a crack at doing these. So if everybody's hopefully got either a spreadsheet or a pen and paper and a calculator somewhere in front of them. I'd love you to have a crack at these. We're going to start off with what I think is a more straightforward one, just to get everybody warmed up. And I'm going to set you one that's really quite challenging that we can have a good discussion about. So, example question number 1. And I would say this is something that you would hopefully be cracking out fairly quickly in the exam, whether it's ACCA or CIMA P2, if you get to it. So I'll give you a little space to share your answers to this once you get it. I'm just going to drop this down the bottom of the screen. And I'm not broadcasting the results yet. I may not broadcast the results, but I'm fascinated to see how you guys find this. And if anybody has any questions for me while you're doing it, don't be afraid to chuck them in the chat pod. My first bit of advice would be to write down the timing of the cash flows. Got a couple of correct answers so far, which is good. Thanks, Helmut. Give everybody a little bit more time to have a crack at this. Okay, give everybody a few more moments to submit an answer, and then we'll talk about how it works. Okay, so let me move this over to one side so everybody can see the screen unobstructed. And let's reveal. So, like I said, the first thing to do is to make sure that you're happy with when the cash flows are happening. This was quite straightforward in that respect because I didn't leave any gaps of more than a year between any of the cash flows, but certainly the examiner might. So watch out for that. And secondly, there were two approaches that we could take to it. We could go with the exact approach and use 1.15 and 1.15 squared or 1.15 cubed to divide our numbers by to find those present values. Or we could go to my discount table, and it's 15% we're looking at now. So if I go back to our present value table, we had 15% for 1 year, 2 years, 3 years, 4 years. So 0.87, 756, 658, and 572. Doesn't matter which way you prefer to do it. If you're doing it in a big all singing, all dancing, say ACCA FM question, you're probably using the discount factors in the second method because they want you to present it like that. If you're doing it as part of a short form question, it might be easier for you guys to use the first method. It depends. Okay. Hopefully that was working okay for everybody. Certainly, if anybody had any issues with that, then give me a chat in the chat box, or maybe give me a red cross or a hand up, and we can discuss it. But that was just the appetizer for what I want us to have a think about as a second, more challenging question here. So MPV question 2. Here we go. And I'd love you guys to try to use annuities to value this rather than simply trying to PV 7 different cash flows. And again, I'll give you guys a pod to answer in. Just chuck that down here. And I really recommend you jot down each of the cash flows and their timing. This is a very easy one to screw up in terms of lengths of the different annuities. Sorry for saying such a nasty question to finish off with, but just want everybody to have the chance to tackle something a little harder. Have our first submission. Obviously, with this kind of question, there's quite a large amount of discrepancy you can get depending on whether you use exact numbers or if you use the discount factors or annuity factors from the tables. But in ACCA FM, they would, in the section C questions, they wouldn't mind as long as you use the right approach. And for CIMA, they would ask you to give it to the nearest, say, £1,000 or £100, so that rounding wasn't an issue. No problem, Raki. Hope your meeting goes well. We'll be circulating the recording of this, so you can always catch up on the last little bit. No problem at all. Guys, my advice is to treat the £200,000 cash flows and the £150,000 cash flows as two separate blocks, two separate annuities, and deal with each of them in isolation. Okay, let's discuss how this works. I think you guys found this a little bit more challenging than the first example. Okay, so first things first, let's jot down what the cash flows are. So here we go. We have got, crucially, a standard 3-year annuity starting in year one. So I can go ahead and value the 200 grand fairly straightforwardly. And then we've got 4 years of £150,000 cash flows. So the easiest mistake to make here is see £150,000 in years 4 to 7 and say, well, 7 minus 4 is 3. So that's another 3 years. But remember, it includes year 4. So 4, 5, 6, 7. 4 cash flows of 150 grand. That's why it's so important to write these cash flows down before just jumping into the question. So like I said, we're going to value the £200,000 annuity in a fairly straightforward way. So we've got a 10% cost of capital. So all we're doing is we're popping over to our annuity factor table, like so. And we're saying we want 10% for 3 years, so 2.487. And then I can use that to value the early amount that we've got, the £200,000 for 3 years. So that block of 3 lots of 200 grand is worth 497,400. You would have got a slightly different answer had you used the annuity formula rather than using the numbers from the tables, because the numbers from the tables are rounded to 3dp. But more importantly, what about the next bit, the 150 grand? Well, that's a delayed start annuity, and it starts in year 4. We can still use the classic annuity factor or annuity formula to turn it into one lump sum. So again, it's a 4-year annuity. So if I go to my annuity factor table, I can say, well, 3.17 is my 4-year annuity factor. That gets me to £475,500 when I multiply it by the 150. But all that's doing is giving me a year 3 value for those cash flows, because it's compressing them into one lump sum as at 1 year before the first cash flow happens. Okay, then the final thing we need to do is just present value that back to T0. So I'm looking for the 3-year discount factor now. Again, I go back to my tables. I'm now looking at the present value table or discount factor table for single cash flows. And I can see that 3 years is 0.751 for 10%. So therefore, multiplying by 0.751 takes that back to 357,101. Suddenly things aren't looking so great. I've got an initial outlay of 1.2 million and then PVs of 475 and 357. So we are definitely saying no to this project. It has a negative net present value of about £345,500. So that is to say that if I borrowed this 1.2 million at 10% interest, went through this project, by the end of it, I would have a deficit left over. I wouldn't have enough money to pay back all the debt. And the present value of that deficit would be £345,000. So definitely a project to steer clear of. I wouldn't have enough money to pay back all of my providers of finance, which is bad, bad news. Guys, any questions arising from that you'd like to pose to me here? The chat box is your friend if there's anything that's troubling you from that. Because I could see that people were finding it a little bit more difficult than the first example that we had. Okay, I'm getting radio silence. I think it's been a fairly intense hour. It's been like an incredibly fast half marathon. Everybody's been on the limit from the start. Let me just see what Marta's typing real quick. Good to know, Marta. Thanks very much. All right, guys. Well, I know we didn't get into inflation. I know we didn't get into tax, but we only had an hour to play around with. And Marta's quite right. The thing I really want to take you away with is the keys to unlocking annuity and perpetuity questions, which are the downfall of so many in P2 and FM. As far as a wrap up is concerned, well, I guess the thing I wanted to pose to you guys is whether you had any further questions. And if you do, then you don't need to chat it to me now in the chat box. There's my email address at the bottom, peter@fi.co.uk. pete@fi.co.uk also works if you haven't quite got the energy to type the extra R at the end. And I'm more than happy to advise you on anything, because like I said, I teach all four of the qualifications and basically any paper that contains any hint of present valuing or investment appraisal. Other than that, guys, thank you so much for turning up and enduring me for an hour. Like I said, I've given you guys the leaflets for the brochures for all of our second half dates. If you're thinking about planning your next paper and next exam you're sitting, if you've got any questions about the exams themselves, then again, don't hesitate to get in touch. Other than that, thank you very much. And if you haven't had lunch yet, please, please, please go and have a sandwich, a wrap, a salad, some falafel, whatever it is. Get the carbs and sugar in you so that you don't wilt in the second half of the day. Fantastic, guys. Thanks so much for coming along.